We're now in the sixth week of the war with markets confused and volatile. The optimism seems to have vanished, replaced by growing uncertainty and a lot of noise out of Washington. Today, we're thrilled to be joined by a man who never shies away from tough call, David Rosenberg of Rosenberg Research. Is this market chaos just temporary noise? Or are we missing a massive warning sign hidden beneath the headlines? With a historic change in Fed leadership coming up, we're asking the hard question. Should you hold cash, or is this a rare buying opportunity for investors, or is it something else? You don't want to miss David's sharpest insights. Let's dive in. Today, we're delighted to have economist David Rosenberg with us on the show. David is founder and CEO of Rosenberg Research and Associates, which provides investors with insights and perspective on macroeconomic research and investment strategy. He was previously chief North American economist and strategist for Gluskin Sheff and Associates, a large Canadian wealth management company. Prior to that, he was chief North American economist for Merrill Lynch in New York, where he was consistently ranked in Institutional Investor's All-Star Analyst rankings. David, welcome to the show.
Well, thank you for inviting me on. It's a pleasure.
So you've been a prominent voice on Wall Street, for years, and known for your sharp, independent, and sometimes funny analysis. But for our viewers who might be meeting you for the first time, can you just briefly, tell us a little bit about yourself and the work that you do at Rosenberg Research?
Sure. Well, I had the good fortune of starting my career as a street economist at the Bank of Nova Scotia on October 19th, 1987. So
that's a date.
Monday, the date. So that's a real great learning lesson. But what it taught me was two things really. The difference between a liquidity event and a real fundamental event. So that was a liquidity event, and then of course the recession started 3 years later. Under a different war, Gulf War I. I'm sure we'll talk a lot about the current war, but that there's a big difference between a correction and a recessionary bear market. And what I also learned at a young age as an economist who was there to help guide investors, was how to basically connect the dots between the macro and the markets. In other words, you don't just stop forecasting at GDP. You take the GDP and then you tie it into an investment objective or a market call. But the main aim is to always be relevant for people that manage money for a living. So that's really been, what we say, my stock and trade, or my profession for 40 years. I spent most of my career at either big banks or, as you'd mentioned, Gluskin Sheff, wealth management companies. And then at the beginning of 2020, just before COVID, so it goes to show you what great market timing I have, I finally decided at the age of 60 to start my own company, Rosenberg Research. And it was because after being on the sell side and the buy side, I realized that there really is a dearth, a deficiency of supply of unbiased, unvarnished economic and financial market research. So I was really always longing for the day when all I had to do was pitch my ideas, not pitch the product for the company I was working for. So it's been wonderful. I have 2,300 clients in 40 countries, and we have clients in Asia and in Korea. So we're everywhere. And our research mirrors our client base. It truly is global, covers all the economies around the world, all the sectors, and all the asset classes.
I love the fact that you say you get relevant advice, and having seen a lot of sell side economists, sometimes they start talking and like 5 minutes later you've gone cross-eyed. Like, tell me something I need to know, so I can recommend the right trades. But as you mentioned Gulf War I, and you could arguably say maybe we're in Gulf War III. So for the 1,000-pound gorilla bouncing around in the room, the war is in its sixth week. A lot of volatility in the markets, although today's been relatively quiet. I think there's an assumption that once this gets resolved, whenever that might be, that the markets will resume its journey higher. Do you think that this conflict, whenever it ends, has changed anything structurally, and people are maybe too sanguine about saying, "Oh, once it's over, we can just go back to whatever we were doing"?
Well, this is a very complicated war because Gulf War One was really about land. It was about Saddam Hussein invading Kuwait, had his eyes set on Saudi Arabia, and next thing you know, you have Operation Desert Shield in August 1990, culminating at the beginning of 1991 with Operation Desert Storm. That whole conflict took 6 months, but really the hard part was really in about a month. But that was a relatively simple war when you think about it. It was basically the conclusion or the goal was to get Saddam Hussein to surrender and leave Kuwait and leave Saudi Arabia alone. And that's exactly what happened. So it's one thing to have a war about land, but another one when it comes down to ideology and existential threat. And I'm not going to pretend that I am an expert on geopolitics, but I am an interested observer. But this is far more complicated because it is about theology and about radical Islam theocracy and about a threat to the entire world, as far as I see it, or at least in terms of the Western world. And so it's different in that respect. And then, of course, we have this other aspect, which is that the Strait of Hormuz was not being a chokehold on the global economy in 1990 and 1991. Not that oil prices didn't skyrocket. They went from $15 a barrel to 40 in fairly short order. And then we actually had a recession that not even Alan Greenspan thought we were going to have. Started in July 1990. And if you go to the FOMC transcripts in July 1990, Alan Greenspan is there telling everybody on the Fed he doesn't see a recession coming. It was starting that very month, which shows you just how important energy is. And that's the case even today, notwithstanding the fact that the U.S. is a net energy exporter. And you could argue that in a service sector economy, energy is less important than it used to be 30, 40, 50 years ago. But it's going to be difficult to define how the markets turn around in any durable way because of all the uncertainty. There's two things that I would point to. The hostilities may come to an end, but does this war end with the Iranians still in charge of the Strait of Hormuz, which is one of the top two or three critical shipping waterways in the world? That's one of their conditions, of course, to the United States. So the war could end, as you said, but will the markets rally if Iran still even has partial control over the Strait of Hormuz? That, to me, as far as the markets are concerned, I mean, war is a horrible thing. I think we would all agree with that. But the markets have been weak and volatile because of the fact that you've only got a trickle of ships going through the strait. And that's been a stranglehold on a whole range of commodities, not just oil and gas. So that's a complicated factor. And then I think the second thing is that what you'd want to have after the war ends is a quick reversal in oil prices. And actually, historically, when you've had an oil price shock to the upside, it's a classic case of the best cure for inflation is inflation. So oil prices go up, and that sows the seeds of its own demise, and oil prices come crashing right back down again. It's not going to happen this time around because you've got so much shut-in production, and you've had so much destruction to oil production facilities in the Gulf that the supply constraints on crude means that oil prices are going to stay way ahead, well above, let's call it the $60-$65 a barrel level we had for WTI before the war. We may get up to 120, maybe 150. I'm not convinced we're at the peak just yet. And then maybe we settle in at around 90, which would still be more than 30% above what the normalized level was before the conflict broke out. So I wouldn't get, there'll be obviously a knee-jerk market reaction if somehow we have a kumbaya moment and there's going to be peace in our time. Um, but there's going to be a whole bunch of other complications. And the key will be when and in what way does the Strait of Hormuz open? That first and foremost is what's most vital for investors today, tomorrow, and the day after tomorrow.
It's a great point. I think that people are thinking about that snapback that's probably not going to happen with, as we say, with the damage and other things. Um, you've spoken recently about your concern, before this all transpired, about the valuations in the U.S. market, specifically, how the 30-year tips are yielding 15 basis points more than equities' real earnings, as measured by the CAPE ratio, which was about 40, I think, when you talked about that. So,
Yeah.
kind of a two-part question: where do you think that ratio should be, I guess? And what CAPE ratio would make you more comfortable about valuations? We just set aside the war and its impact, aside for the moment.
Yeah, well, the CAPE or the cyclically adjusted PE multiple, I mean, it goes back more than 100 years. I mean, the normalized level is like 25. So when we're 39. So it's come down a little bit, but the U.S. stock market, I'm not saying the global stock market,
Right.
the U.S. stock market is still has valuation problems. I mean, the S&P might be down 8% from the highs. I mean, that's nothing. You compare to what we went down during Liberation Day almost a year ago,
Right.
or where we
Yeah.
went down in Gulf War One, we were down 20% at much better valuation levels. So the valuation constraint, and you mentioned equity risk premium. Of course, the one thing that you like to see, if you want to get back in the stock market, you want to see bond yields go down. You want to see the relative value, not just absolute value, the relative value in equities improve. And that usually comes when interest rates come crashing down. That's what happened, for example, March of 2009. Besides the fact that we had TARP and we ring fenced the banking system, the Fed brought the funds rate to zero. Bond yields came crashing down to like below 3%. And that breathed relative value life into the stock market. Just do the arithmetic, and all of a sudden the equity risk premium is looking nice and juicy, so you're getting paid to take on the equity risk in the S&P 500. As you said, even today, because bond yields have gone up, not down, even the modest improvement in equity valuation still means that the equity risk premium, when appropriately measured, is still slightly negative. So it's still not an appealing buying opportunity on valuations. And the one thing I would just tack onto that, and I think you mentioned it, is that even before the breakout of the war in late February, the stock market was having its problems. I mean, it was basically showing signs of topping out, reaching fatigue. I mean, we weren't down 7 or 8%, but the market was really topping out. When you think about it, since October, and had not been doing anything except moving in a very tight trading range. So the weakness in the market was evident months before the conflict. And there's a whole bunch of other things going on at the same time. When you mentioned we end the war, are we off to the races? Well, we have all the problems, with private credit. And, Jamie Dimon put out a letter saying he doesn't expect it to be systemic risk. I don't either. But, we talked about Gulf War One in 1990. If you remember, that was not private credit, but that was the regional banks and the LBO craze coming to an end and commercial real estate. And that wasn't systemic. It didn't affect JP Morgan or Morgan Stanley or Merrill Lynch, but it led to about a 3-year credit crunch where it was very tough for small companies and consumers to access credit as risk aversion crept in. And that's what's going to happen, I think, this time around. You don't have to go to the Armageddon and compare it to the great financial crisis. You don't have to compare it to systemic risk. It's not going to bring down a bank, but the banks are heavily exposed. It's going to lead to a pullback in credit extension, generally speaking. So you got the prospect of a credit crunch stemming from private credit and private equity. You got the AI disruption on the job market. Now AI is cutting both ways. And now you're seeing in the data, you can really see clearly that AI is having a very big impact on hiring activity, really going down substantially. You've got a tightening of financial conditions. Of course, that's the derivative impact of the war. Financial conditions have tightened enough. It's as if the Fed's already hiked interest rates 2 times.
Wow.
You've got these other, negative shocks right now. We haven't seen the peak impact. We're going to get an inflation number soon for the month of March, and it'll be the first of several. Now, I'm not in the big sustainable inflation camp. This is a supply shock, but it lasts a few months. It's going to have a serious impact on real economic activity. And it's not just about gasoline over $4 a gallon at the pumps in the United States. It's also diesel, which affects transportation costs, and then that affects food costs. So you're going to find over the near term that the inflation, this cost push inflation, is going to lead to a decline in real incomes, and that will lead to a decline in real consumer spending, which, after all, is 70% of the US economy. And I think that people have grown to be a little complacent because the US economy is like the cat, that proverbial cat with 9 lives. And we had the last time we had an oil price shock like this, when Russia invaded Ukraine back in 2022, the US consumer was still swimming in that $2 trillion of excess savings, courtesy of all the fiscal stimulus checks coming out of the US government. That doesn't exist today. There's no offset today. The Fed's not coming to the rescue. Fiscal policy is not coming to the rescue. And we are going to see, I believe, the next, call it 3 to 6 months, because there's going to be a lingering impact here. There's going to be a domino impact, some serious deterioration in the economic data.
In terms of, just for folks who are looking at the market, with the S&P, does it need to be 5,000, 5,500, where you feel a little bit more comfortable that enough people have taken their lumps that there may be some opportunities that one might consider?
Yeah, it's hard to know, what the level is. You also have to take a look and see, what are earnings expectations. They haven't come down yet, believe it or not. So even when you talk about the forward multiple, it could be even higher than we think, because earnings estimates haven't come down. I guess we'll see what happens. We're just a couple of weeks away from the first quarter earnings season. I would say that, some rules of thumb. If we got the VIX between 40 and 50, that's usually a sign of a washout. You really want to see sentiment washed out. It's not just a valuation story. That's important, but you want to see the complacency morph into, what more can I say? Greed morph into fear. Right now, for example, one of my favorite weekly barometers of market sentiment is Market Vein. And as we sit here today, it's 60% bullish. It's at the high end of the range, despite everything we've been saying. Normally, you'd like to see that get between 20 and 40. That is a capitulation washout point. If it happens with the VIX between 40 and 50, I don't really know what level the S&P 500 has to be at, but I know that I'm looking first and foremost at sentiment. And when the greed turns to fear, those are the best times to, start putting liquidity to work and adding some toes to the risk pool. So that's what I'm watching first and foremost, because the sentiment indicators, they move more quickly, but they'll give you an entry point, re-entry point into the market ahead of the valuations, which is a much more slow-moving process.
Fair enough. You mentioned interest rates, and the no one's paying much attention to the Fed right now, because I think it seems like they want to sit on their hands with all this sort of volatility around that they can't really, they're not designed to handle. I think at one point you thought 2 interest rate cuts this year, but is the Fed, can the Fed do anything at this stage in terms of, they need to see what inflation happens, even though it may not be core, it may be headline over the next quarter or so. No matter who replaces Powell, if someone, if Warsh or whomever it is able to be confirmed to replace him, will the Fed likely do anything this year?
Well, I haven't backed away from my call, and it might be more than 2 cuts. When you say by the end of the year, remember, there's 9 months to go, and that is a long time. So I think a lot's going to change between now and then. I think in some sense, the Fed is sort of caught in its previous rhetoric when it talked about transitory back in 2021, 2022. It wasn't transitory, but you see, what happened then was that the inflation fed into wages because we had a labor market that was heating up. We don't have that today. And on top of that, we went from 0% inflation to 9 back during COVID and the aftermath of the pandemic. But if it was just about the supply bottlenecks and supply chains being impeded, we would have peaked at 4.5. So half the inflation came from the demand side. When you start printing money and giving it $2 trillion of stimulus checks, that was unprecedented. And every penny of it got spent. So it was all happening as the economy was reopening. And the government paid people not to work. So companies had to bid up wages a lot to attract labor. But the Fed is sort of fighting the last war, to bring up war. They're still sort of caught in their own mistake, and they're like deer in the headlights. So they're being deliberately slow. It's almost not much different than a year ago during the tariff file and all the uncertainty. And Jay Powell at one of the meetings gave this analogy where he said, "Well, what do you do when you're in a dark room filled with furniture? You stand still so you don't trip." So this is slightly more serious than just Liberation Day, but we're back to that period of time where the Fed is just unsure. They're also unsure whether or not policy is still tight. A lot of them think that they're at neutral. A lot of them think that the labor market is in equilibrium, despite the fact that when you strip out health and education, the U.S. economy has actually lost jobs over the past year. We're down to just one leg supporting the economy, which is something that's not even cyclical. It's health and education services, and that's really more demographic. But the areas of the labor market that are most sensitive to shifts in the business cycle, they've been in contraction mode, and that even includes, last month's headline number of 178,000. If you actually believe that, that number will for sure get revised, as they all have over the past year, and probably down. But the Fed is caught in a box here. They do have concerns about the labor market, but it looks as though their biggest concern right now is on inflation. Now, that's not my view, that's their view. But to me, the big problem for the Fed will be is if we get a repeat of 2021 and 2022, where the headline shock feeds into core. And if the headline shock feeds into wages, then that becomes a situation where not only is my call going to be wrong on rate cuts, they'll be hiking rates. But I don't see that happening. I see that the labor market has more slack in it than is commonly perceived. If you noticed, in March, average yearly earnings were only up 0.2%. The year-over-year trend in wages is 3.5. A year ago, it was 4.2, and it's the slowest it's been in 5 years. And the proof of the pudding is always in the price.
Yeah,
And
you're right.
the price of labor is slowing. So that's not telling you immigration outflows aside or labor force depletion aside, the deceleration in nominal wages is telling you and telling me and telling all the viewers that the labor market is developing more slack. That's what the Fed should be concentrated on, not the U3 unemployment rate, but what is the direction of nominal wages? You see, that was not happening. Wages were accelerating. That's really where the Fed got it wrong, was the feed through from prices to wages. And we had an 18-month spiral. It wasn't the 1970s, but 18 months is not exactly anybody's definition of transitory, but it fed into wages and it fed into core. So we'll have to focus on wages. So far, they're still decelerating. We'll have to focus on core and see if this price shock morphs beyond just food and energy. And we know it's going to hit food as well. And that's doubly important as to what energy is. The question is, what does the other 80% of the index do? And how does that influence inflation expectations? Now, the thing is that, I mentioned that Alan Greenspan, I thought he was a great central banker. Nobody's perfect. He completely missed the recession call in 1990 when it was staring him in the face. But if you go back to that Gulf War one that you and I were just talking about a few minutes ago, inflation, oil prices more than doubled, and inflation got up towards 6, 7%, let alone 3 or 4. And he cut rates 5 times during the Gulf War. And then he kept on going after that because he realized we're in a recession. And the reason why he cut rates 5 times, now remember, he was doing that not even knowing that the recession had started, was because he had detected that the price shock from Gulf War One was not feeding into wages, and that core inflation actually was stable to lower. So I think if those conditions are met, and it'll take probably 3 or 4 months, and especially under the Warsh Fed, and you know that Warsh does want to cut rates, uh, I think they'll be cutting, but we'll need more information. But
Right.
because I believe that this price shock is going to hit the wall in the labor market, and instead of broad-based inflation, what we're going to end up with is contraction in real incomes and real consumer spending. I think the Fed's going to pivot in the second half of the year, and that's why I'm still sticking to my rate cutting call.
But I do want to get your thoughts on the Korean stock market, the Kospi, as well as is it still semiconductors? Is that still the sort of memory chip index? And also, a lot of folks are asking, should we hold cash like Warren Buffett, or we start thinking about picking up some bargains, or where are we in that? And now I know you mentioned that sentiment, at least in the U.S., is still very high, but how do you feel about the Korean market?
Well, we actually were very bullish on the Korean market. It was actually heading into this crisis, one of the top performing stock markets of the world, and certainly was a leader in Asia. And we had written about it, and a lot of it was because very great valuations and great earnings growth expectations. When you look at the price earnings growth ratio, the PEG ratio was very attractive in Korea. We're still basically long Asia. We look at Asia really as the world's growth leader. And of course, that includes China. You could actually argue that China comes out a big winner out of this war, and China comes out a winner out of the tariff war. I got to say that you got to tip your hat to Xi Jinping. He knows what he's doing. But we own Asia ex Japan, and like gold, when this conflict ends, we're going to probably add more of our positions to the bullish Asian trade because it is a secular trend. It's not just something that you're going to buy for a few months. So we're still believers in Asia as being the hotbed of economic growth and with very dynamic populations. I mean, you're taking a look at Europe and the United States and even in Canada, populations are starting to decline. Working age populations are declining. So you're seeing a much more vibrant, I'll leave Japan out of it, of course, but a much more vibrant, and I'll leave China out of this part, but much more vibrant demographic base in most parts of Asia. So it's a region that we still like. Yes, it's very technology oriented. That much is true. But when you take a look historically, again, when you're looking at the sectors that you want to own long term, I point to three. And they're all in the growth arena. I point to technology. I point to healthcare. I point to consumer staples. And we own all three of these sectors globally. In fact, all three, if you take a look over the past 40 years, if you own three sectors equal weight, technology, healthcare, and consumer staples, they've done far better than any other trifecta of sectors you'd want to own. And if you're looking regionally, Korea is a very nice microcosm of that sector trade. So yeah, our long-term view of Korea, in particular Asia, as well, in general, the longer-term prospects are still very positive. Well, and where we're going to come out of this, by the way, is areas in Japan and Asia that were very dependent on Middle Eastern oil, and that's going to come to an end. And I think you're starting to see signs already. By the way, not just in Asia, but also in Europe, this move towards nuclear energy and clean energy. really, I think people will be following the China model. One of the reasons why people talk about how China bought all this cheap sanctioned oil and had many months of reserves before the war started. I don't know how Xi Jinping knew this was coming. I don't know how Xi Jinping knew that Trump's tariff policies were coming. He's a visionary. I don't know how he knew. But like half of China's energy consumption comes from clean energy, the same energy that Donald Trump's walked away from. But I think that Asia in general is going to be developing those energy technologies, and Korea will be part of that as well. So, we trimmed our positions just to de-risk at the margin. But one of the first things we're going to do, I mentioned getting back into gold once the war ends, assuming that it ends in a certain fashion, which includes the Strait of Hormuz. But we will probably reallocate even more money to the Asian trade once this is over.
David, thank you so much for the insights. Would love to have you again on the show sometime very soon.